Imagine you inherit a piece of land from your parents. You pay nothing for it. Years later, a buyer offers to buy that property, let's say at 10 million, and you agree to sell that property. Now that you've finished imagining, let's take back to the real world. Because I'm not sure that one is going to happen. But let's say, because you live by faith, let's assume you are right and we're going to inherit a property. The reason why this is important, there is something that is called the capital gains tax. And the question that wakes you up tonight is this: will KRA tax you on the entire 12 million that you've sold the property for? Well, because you've paid nothing, you just inherited the property, or should you be taxed on a different amount? Now, that question has a very clear answer. And the answer is not what KRA wants it to be. Let me explain. Capital gains on inherited property is one of the most misunderstood taxes in Kenya. For years, even experienced tax professionals have given contradictory advice on this exact question. Some say the acquisition cost was zero because you paid nothing to acquire that property. Others say you could use the market value for that property at the date of inheritance to calculate what you bought that property for. But what's most important is KRA does not reason in any of those two ways. KRA took the zero cost position that you didn't pay anything for it, so the whole amount is taxable. When KRA did that, two families went to court, and the court gave you a ruling. And the ruling was not what KRA wanted. But then KRA had a simple win because Parliament added a twist that means the timing of when you get the property as inheritance and when you sell that property matters as much as the question of what you paid to own the property. Today's case is a case with different twists and turns. I hope you have your safety belts on because it's going to be one hell of a ride. So let's get on. The first family in this story actually sold their inherited land for less than it was worth when they inherited it. So, because they sold for less than what it was worth, they declared a loss. Even though they declared a loss, KRA went ahead and issued a capital gain tax demand of 27 million because KRA claimed the full amount was taxable. So there is no way the guys could have made a loss. Now, the second person inherited land. We waited 8 years and then sold that piece of land for a modest gain. Now, they went ahead and calculated the gain on the difference between that valuation and the selling point. Then they paid the tax on that gain. But KRA disallowed this entirely. And both of these families fought. And they fought KRA, and both of them fortunately won. But Parliament then changed the law in a way that means that if you sell your property too quickly after inheriting, then your story may have a very, very different ending. By the end of this video, you will know exactly how to calculate your capital gains tax in case you've inherited a property. I will also explain to you what that 5-year rule means for you, and by getting a professional valuation immediately after you inherit a property would save you millions. I'll also let you know the filing deadline for capital gains tax, and by missing this deadline is extremely and highly expensive. So let's look at the first case, and this is the case of the Shah siblings. In the year 2015, three siblings inherited two parcels of land from their deceased father. What they did, they engaged NIFAM. This is one of Kenya's most respected independent valuers who determined that the total market value for the properties at that time in 2015 was 389 million. 5 years later, in 2020, the siblings sold this same property for 305 million. This is way less than the inherited value. Remember, NIFAM had given a valuation of 389 million. So let me ask you how they sold the property for 100 million less than the valuation. Because I'm not a valuer, I don't want to guess why they did. And your guess is as good as mine. But based on the inherited value and adjusted for cost, they declared a loss of 99 million. And because they went to a loss, they paid no capital gains tax. But KRA disagreed. What KRA did, they went ahead and issued a capital gain tax demand of 27 million, and their argument was because the siblings had paid nothing to acquire the property, their acquisition cost was zero. If the acquisition cost was zero, then the entire price that they sold the property for was a taxable gain. Now, with the three siblings facing 100 million requests from KRA, they sat down, but they were not scared. What they did, they looked at KRA right in the eyes and told KRA what we all wish we could, but we can't. They told KRA, a suing court. And true to their word, the siblings appealed. They presented their case. They argued what the law provides for. They said their transaction was above board, and they claimed that they had actually made a loss. But KRA was unperturbed. They countered every line that the company was coming up. They countered every line that the siblings provided because KRA had come prepared. Now, as they sat down, KRA knew that this case had already been won. Now, the Tax Appeals Tribunal looked at paragraph 9 of the 8th schedule to the Income Tax Act. The Act provides that when a property is acquired, other than through an answering purchase, and this includes like inheritance in this case, the transfer of such a property is deemed to have occurred at the open market value of the property at the time of acquisition. This being the case, it means that KRA was wrong to say that the cost was zero, because the market value at the inheritance is the cost base that should be used. Because maybe I've used a lot of English, all you need to know is that the law says the inheritance valuation is the same as the purchase price in this case. And you should be knowing these things by now, unless you haven't been watching most of the videos I made. So I suggest you go back and look at the few videos I've made around KI. Now, since the siblings sold the land for less than the inherited value, there was no gain and there was no capital gains tax. That is not me saying it, that's the tribunal. And when KRA had that, they were in anger. They couldn't agree to this because it will open a window to so many people to inherit land, sell it to relatives or to related companies or to friends at a loss. Or people could do some fishy stuff to avoid paying tax. So KRA appealed to the High Court. But as KRA was doing this, the siblings were not asleep. Now, these siblings asked the lawyers to get back to the ring. In this time, the lawyers did something different. They learned how to finish someone and finish them completely. That's a book by Machiavelli. The lawyers took notes. They analyzed the strategies. And they were ready for battle at the High Court. Now, in the High Court, the lawyers remembered something. That you need to crush your enemy, you need to crush them completely. And the lawyers, knowing that, presented even a better case. But, and it was around June, and before the effects of the budget could be felt by the monarchy, something happened. The High Court, on around June 2024, upheld the ruling of the Tax Appeals Tribunal. The Shah case established what is now called the rebasing principle. On the rebasing principle, but let us go back to the second case, which is the case of Dajjal. And here is that case. Now, Dajjal inherited land in 2014, and as we saw, they obtained a professional valuation, pegging the price at 150 million at the time of inheritance. So he inherited in 2014. In 2022, he sold it for 177 million. Remember, price at inheritance 150, and he sold it for 177 million. Given this, he declared capital gain of approximately 21 million, and using this 21 million, calculated his capital gain tax and paid it to KRA. But KRA disallowed the entire 150 million acquisition cost, and KRA argued that because he had inherited the land rather than purchased it, he had not used anything to acquire the land. Under KRA's calculation, he would owe tax on the full sales proceeds. And if this happened, this would be a much larger liability than he had actually paid. So, same case as the previous case, the Tax Appeals Tribunal rejected KRA's argument. The exemption from capital gains tax applies when property is transferred during administration. And when this happens, it means the transfer itself is not taxable. The tribunal looked at the law. The market value at inheritance remains the tax base. That's the law, and KRA can't change that. Second, the tribunal also gave significant weight to the professional valuation report that had been presented. The tribunal noted that third-party valuations from a qualified professional carry a lot of weight when it comes to providing evidence around tax disputes. And in this case, Dhanjal won. The 150 million that he had used as the cost of acquisition was upheld. Across the road, Parliament was watching these cases. And in the Finance Act of 2023, Parliament introduced paragraph 4A of the 8th schedule in the Income Tax Act. And this is what now practitioners are calling the 5-year rule. This provision says that when a property is transferred in a non-capital gains tax transaction, such as inheritance, and that same property is subsequently sold in a taxable transaction within less than 5 years, then the cost of that property for capital gains tax shall be the original cost in the hands of the deceased, not at the market value at the time of inheritance. Let me say in plain terms, if you're selling inherited property, within 5 years of inheriting it, you step into the shoes of the deceased. So once you step into the shoes of the deceased, you are going to use whatever they had paid for the property when they bought it. If you wait more than 5 years before selling, then you get the benefit of the reduced market value at inheritance. The difference is very enormous. Here's what you must do. The moment that you inherit a property, please go ahead and request for professional valuation from a qualified independent valuer and make sure that you are keeping that report. That report could be your future cost base if you sell after 5 years. If you sell before 5 years, you will need to show the original acquisition documents.